When a creditor willingly accepts a loss, it is rarely a mistake. In stable systems, losses are avoided, deferred, or socialized. They are not chosen, yet in recent months, China has reduced its exposure to United States Treasury debt by an amount approaching $688 billion, doing so at prices that are locked in real losses rather than preserving nominal value. This was not a miscalculation. It was a decision. Throughout history, great financial shifts have rarely announced themselves through collapse. They have begun with withdrawal. Empires do not usually fall because creditors are forced out. They weaken when creditors decide, quietly, that staying no longer makes sense. Capital leaves not in panic, but in sequence. First, exposure is reduced, then dependence is questioned. Only later does public stress appear. The central mistake in most commentary is to frame this moment as a bad trade. That framing assumes markets are the highest priority. For sovereign actors, they are not. Sovereign debt is not merely a yield-bearing asset. It is a geopolitical relationship built on assumptions of legal neutrality, currency stability, and predictable policy behavior across decades. When those assumptions hold, losses are intolerable. When they break, losses become acceptable. The more important question, then, is not why China lost money, but why losing money became preferable to remaining exposed. That question forces a different lens. It shifts attention away from charts and toward risk models that account for power, leverage, and constraint. It acknowledges that certainty, even at a cost, can be more valuable than optionality that may disappear under stress. History offers consistent examples of this logic. Major creditors have exited dominant powers before currency crisis, before political rupture, and before markets recognized structural change. These exits were rarely public. They appeared, in the moment, irrational. Only later did they make sense. This documentary begins at that point of confusion. Not to predict collapse, and not to dramatize loss, but to examine structure. What changed in the global system that made the world's largest creditor choose a known loss over continued participation? When rational actors accept losses voluntarily, the system they are leaving is already changing. Understanding that shift requires stepping back from daily market noise and recognizing that power is revealed less by statements than by allocation choices made before consequences become visible. Those choices are rarely impulsive and almost never accidental. To understand why this system matters, it is necessary to understand how United States sovereign debt was designed to function. Treasury securities became the world's primary reserve asset not because of yield, but because they sat at the intersection of scale, liquidity, and trust. No other market offered comparable depth, legal clarity, and the ability to move enormous sums without distortion. This made treasuries less a trade and more an infrastructure layer of the global economy. At the core of this system was an implicit bargain. The United States maintained open capital markets, political continuity, and a currency that could be settled anywhere in the world. In return, surplus-producing nations recycled export earnings back into U.S. debt. This recycling stabilized exchange rates, funded global trade, and anchored reserves to a system assumed to be neutral and predictable. Confidence was not a slogan, it was the operating mechanism. Debt issuance, reserve currency status, and trade flows reinforced one another. As global trade expanded, demand for dollars increased. As dollar demand increased, treasury markets deepened. As markets deepened, holding treasuries became safer, not riskier. This circular structure rewarded participation and penalized exit, making long-term holding the rational choice for central banks and sovereign funds. Importantly, foreign accumulation of U.S. debt was never about maximizing returns. It was about minimizing uncertainty. Treasuries functioned as collateral for the entire global system, a place where reserves could be stored without signaling intent or vulnerability. Losses under this model were anomalies to be avoided. This section establishes that baseline. When the system functions as designed, selling at a loss is irrational. Understanding that design is essential because departures from it signal that the assumptions sustaining the structure have begun to fail. It provides the reference point against which later actions can be measured, clarifying that what follows is not routine market behavior, but a response to deeper structural change within the system itself alone. China's accumulation of United States Treasury debt was not sudden, nor was it ideological. It emerged from the mechanics of its post-industrial growth model. As China integrated into global manufacturing networks, it ran persistent trade surpluses with the United States and other developed economies. Those surpluses generated large volumes of dollars that had to be absorbed somewhere without destabilizing its own currency or export competitiveness. Managing that inflow required a destination that was liquid, scalable, and politically neutral. U.S. Treasuries fit that requirement precisely. By recycling export earnings into American debt, China could prevent excessive appreciation of its currency while maintaining access to external demand. This was not an expression of confidence in American policy. It was a practical solution to a structural constraint. Over time, the position grew because the system rewarded consistency. Holding treasuries reduced volatility, simplified reserve management, and aligned China with the prevailing rules of global finance. Deep participation signaled stability rather than dependence. It allowed China to expand without forcing abrupt changes to trade balances or capital controls. Accumulation, in this context, was cautious behavior, not leverage building. This distinction matters. China's role as a major creditor reflected integration into an existing order, not an attempt to control it. The reserves were a buffer, not a weapon. They anchored China's financial position to the center of the system at a time when alternatives lacked depth and reliability. Understanding this phase clarifies the significance of what followed. When a position built over decades, optimized for stability, is unwound at a loss, the cause is not tactical dissatisfaction. It indicates that the assumptions supporting the original model are being reevaluated. Exits of this scale occur only when future alignment with the system itself is no longer taken for granted. It marks a reassessment of long-term expectations rather than a reaction to short-term market conditions, underscoring that the growth framework itself was entering a period of reconsideration globally. The turning point did not arrive as a single shock. It emerged when multiple pressures converged and began to alter how risk was measured. Rising interest rates increased duration sensitivity across large bond portfolios. At the same time, expanding fiscal deficits changed long-term debt servicing trajectories, raising questions not about immediate solvency, but about policy flexibility under future stress. None of these factors alone would have forced a reassessment. Together, they reshaped the profile of what had once been considered risk-free. For institutional holders, this shift was captured not in headlines but in models. Duration exposure became harder to justify as rate volatility persisted. Liquidity assumptions, once taken for granted, were stress-tested against scenarios involving rapid repositioning by large holders. Political constraints entered calculations previously dominated by market variables. The models did not fail, but they stopped agreeing with one another. Traditional signals still suggested safety. The market remained deep. Settlement continued uninterrupted. Prices moved within familiar ranges. Yet strategic models began to diverge from financial ones. What appeared liquid in normal conditions looked less certain under coordinated exits or policy conflict. What appeared stable in the short term appeared increasingly rigid in the long term. At that point, losses ceased to be accidents. They became parameters. Selling into unfavorable conditions was understood as a known cost, not an error. The question shifted from how much value could be preserved to how much exposure could be reduced without triggering disruption. This reframing is essential. The drawdown was not a reaction to volatility, but a recalibration of dependency. Accepting losses functioned as an insurance premium against scenarios where exit might later be constrained or politicized. That decision marked the boundary between participation and disengagement. From that moment, the relationship was no longer defined by yield or convention, but by risk containment and strategic optionality under changing global conditions that institutions judged increasingly incompatible with long-term sovereign planning horizons globally. At the center of the decision lies a question that traditional market analysis often avoids: why accept a realized loss instead of holding to maturity? Under normal conditions, time reduces risk. For sovereign investors, however, time can also concentrate it. Assets that appear safe on paper can become strategically fragile when the environment surrounding them changes. Nominal safety rests on assumptions. Currency value is expected to remain stable. Settlement systems are assumed to be neutral. Access is presumed continuous regardless of political context. When those assumptions weaken, holding becomes exposure. Currency dilution erodes purchasing power gradually but predictably. Sanction regimes introduce discontinuous risk, where access can be limited without warning. Settlement systems, once purely technical, become instruments of policy. In such conditions, exit optionality becomes the scarce resource. Large positions cannot be reduced quickly without cost. Waiting preserves nominal value, but increases dependence on future cooperation. What begins as a liquid reserve can harden into a constraint, binding decision-making to external actors. Yield becomes irrelevant when control is compromised. Sovereign investors do not optimize for quarterly returns. They optimize for autonomy under stress. Concentrated exposure to a single issuer magnifies vulnerability when geopolitical leverage enters the equation. The asset no longer functions solely as a store of value. It becomes a channel through which pressure can be applied. Seen through this lens, the loss was not incidental. It was deliberate boundary setting. Selling established limits on exposure before those limits could be imposed externally. The cost was measurable and finite. The alternative risk was open-ended. This reframing clarifies the logic of the decision. It was not driven by market pessimism, but by a reassessment of independence. When holding an asset requires confidence in future neutrality, and that confidence erodes, the safer position can be to leave. In that context, loss is not failure. It is the price paid to restore optionality and preserve sovereign discretion. History shows that the loss of creditors rarely coincides with visible decline. Dominant powers often maintain military reach, diplomatic influence, and internal cohesion long after financial confidence has begun to erode. The change occurs quietly within balance sheets and reserve allocations before it appears in currencies or politics. In multiple historical cases, the sequence is consistent. Large external holders begin reducing exposure. These moves are gradual and rarely announced. They reflect reassessments of long-term stability rather than reactions to crisis. Only after sustained withdrawal does currency pressure emerge, followed later by policy responses aimed at restoring confidence. By the time political debate becomes visible, the financial shift is already advanced. What matters is not the specific era or ideology, but the structure. Creditors respond to imbalance before citizens do. They observe fiscal trajectories, institutional rigidity, and limits on adjustment. When the capacity to absorb shocks weakens, capital seeks distance. This does not require collapse. It requires only doubt. Importantly, these transitions are not acts of hostility. They are risk management decisions made under uncertainty. Creditors do not wait for confirmation. They act on probability. The absence of panic is often mistaken for stability, when it is instead the product of orderly retreat. This pattern reinforces a central point. Financial confidence is a leading indicator, not a trailing one. When it recedes, power does not vanish immediately. It reconfigures. Military and political authority may persist, but they operate atop a narrowing financial base. Viewing the present moment through this lens removes drama. It frames the event as part of a recurring process rather than an exception. Creditor exits are not moral judgments or sudden verdicts. They are systemic responses to imbalance, unfolding according to sequence, long before consequences are widely acknowledged. Seen historically, the order matters. Finance shifts first, narratives follow, and reactions arrive last. The distance between those stages defines how change unfolds without spectacle or announcement or alarm signals. When capital leaves United States sovereign debt, it does not disappear. It is reassigned according to a different set of priorities. The question is not where returns are highest, but where dependency is lowest. Reallocation follows logic, not momentum. One destination is commodities, particularly those tied to industrial input and strategic reserves. Physical assets reduce exposure to financial intermediaries and settlement systems. They function outside balance sheets and retain utility regardless of currency regime. This is not speculation. It is insulation. Another channel is bilateral trade settlement. Instead of roading transactions through a single reserve currency, states expand direct exchange arrangements. These systems reduce reliance on external clearing infrastructure and limit vulnerability to policy intervention. The goal is not efficiency. It is continuity under constraint. Capital is also redirected inward. Domestic infrastructure absorbs surplus while reinforcing internal stability. Investment in logistics, energy, and production capacity converts financial exposure into tangible control. This form of allocation is slower and less liquid, but it aligns capital with national priorities rather than external markets. Finally, non-Western financial channels expand in parallel. Regional development banks, alternative payment systems, and localized credit arrangements provide redundancy. Known individually replace the scale of U.S. debt markets. Together, they reduce single-point dependence. What matters is the pattern. Exit is not followed by absence. It is followed by distribution. Capital fragments across assets and systems that trade yield for resilience. The objective is not to outrun risk, but to ensure that no single node can exert disproportionate leverage. This section completes a critical transition in the argument. Selling U.S. debt was not an isolated act. It was paired with construction elsewhere. Parallel systems grow quietly while legacy structures remain dominant. The shift is additive, not confrontational, and it reflects a preference for optionality over optimization in an environment where concentration itself has become the primary risk. This reallocation process unfolds gradually, avoiding disruption while reshaping exposure over time. Large reallocations of sovereign capital are rarely announced, not because they are insignificant, but because they are consequential. Public disclosure can transform a measured adjustment into a signal, and signals alter behavior. For actors operating at system scale, managing perception is part of managing risk. Announcing a large exit would invite interpretation before the repositioning was complete. Markets would anticipate, counterparties would adjust, and political narratives would form prematurely. Silence preserves optionality. It allows internal decisions to proceed without forcing external reaction. This is not secrecy for its own sake. It is control over timing. Power systems have long understood this logic. Major shifts are executed administratively through balance sheets and mandates, not speeches. When action precedes explanation, stability is maintained. When explanation precedes action, instability accelerates. Silence is therefore not passive. It is operational. In this case, quiet execution avoided framing the move as confrontation or judgment. It reduced the risk of retaliatory interpretation and minimized feedback loops that could amplify market response. By the time the data became visible, the decision was already embedded. This pattern reinforces a broader principle. Important transitions in global systems do not announce themselves. They register first in filings, flows, and allocations that appear technical until they are aggregated. Public narratives follow with delay. Understanding this dynamic is essential to interpreting the event. The absence of statements does not imply the absence of strategy. It implies confidence in process. Power that depends on visibility is fragile. Power that can move without notice is durable. This section clarifies why silence should not be mistaken for hesitation. It was a deliberate component of risk management. Acting quietly preserves stability while enabling change, demonstrating that in complex systems, discretion is often the most effective expression of authority. Such restraint reflects institutional maturity, where decisions are implemented first and explained later, ensuring outcomes are shaped internally rather than negotiated publicly under pressure. Large sovereign and institutional holders rarely take cues from public statements. They watch flows. Allocation changes by peers carry more weight than official assurances because they reflect decisions made under full access to internal data and long-term risk models. In that environment, behavior becomes information. When a major holder reduces exposure at scale, it alters the reference frame for others. Not through imitation, but through reassessment. Institutions ask whether assumptions they share still hold. They revisit stress scenarios, exit timelines, and dependency thresholds. This process does not require coordination. It spreads through comparative analysis. Importantly, the signal is not interpreted as a verdict on immediate safety. Markets can remain functional while confidence is adjusted. What changes is the margin of comfort. Risk once considered theoretical becomes assigned a probability. Duration tolerance is narrow. Concentration limits are reviewed. None of this is visible in headlines, but it reshapes internal policy. This is how systemic perception shifts without collective action. Each actor responds independently, yet the aggregate effect compounds. Small reallocations across multiple balance sheets can equal a large structural movement without any single decision appearing decisive. The signal also clarifies hierarchy. When a creditor with long exposure history accepts losses to reduce dependency, it challenges the assumption that holding is always the conservative choice. That reframing matters. It expands the range of acceptable outcomes within institutional planning. The focus here is not prediction. It is process. Institutions do not need to agree on conclusions to react to the same data. Peer behavior becomes a stress input alongside interest rates and liquidity metrics. In this way, one exit functions as a recalibration mechanism. It does not trigger immediate flight, but it adjusts how risk is priced internally. Over time, that adjustment influences portfolio construction and reserve strategy across the system. This section reinforces a central theme. Power transitions are rarely announced, but they are observed. Institutions respond not to rhetoric, but to what other institutions do when trade-offs become real. The signal lies in the willingness to accept cost in exchange for reduced exposure, and that signal travels quietly through decision-making frameworks worldwide. Seen as a financial event, the $688 billion loss appears extraordinary. Seen as a strategic choice, it becomes clarifying. The decision was not a misjudgment of markets, but a judgment about structure. Capital was not misplaced. It was redeployed in anticipation of a different operating environment. Loss, in this context, functions as information. It reveals how actors with long-time horizons interpret constraints before they become binding. Accepting a known cost in exchange for reduced exposure is a forecast, not an admission. It signals that the future will reward flexibility over concentration and control over yield. This does not imply collapse, nor does it assign blame. Systems rarely end suddenly. They reconfigure as participants adjust to shifting incentives and constraints. In that process, finance moves first, policy responds later, and public narratives arrive last. The gap between those stages defines how power transitions without spectacle. Understanding this sequence changes the meaning of the exit. It was not a reaction to stress, but a response to trajectory. The sale reflected a judgment about where the system is heading, not where it stands. Timing mattered more than price, because timing preserves choice. The documentary began with an anomaly, a creditor choosing loss. It ends with its implication. When losses are accepted voluntarily, the story is no longer about money. It is about trust, control, and timing. Systems do not announce their transitions. They reveal them through behavior long before consequences are widely recognized. In this way, the exit functions as a structural signal rather than a financial outcome. It invites analysis of assumptions, not emotion. For observers, the task is not to react, but to recognize that behavior often precedes explanation. Those who watch structure rather than statements see change earlier and with greater clarity. In that sense, the loss was not an ending, but a marker, indicating that the system is already adjusting its internal logic ahead of public acknowledgement and formal redefinition over time. That adjustment is measured, deliberate, and revealed only to those paying attention to choices made before outcomes are forced into view by events, headlines, or crisis-driven reaction later on globally.